Hello, public community, and welcome to another great public live session. Today, we are going to take a deep dive into Nike and really get what's going on between the margins of this company, because they did exceed their quarterly expectations for sales and profit, handling challenges, as we know, that have been ongoing related to inflation and global supply chain snags, much better than Wall Street anticipated that they would. However, rising costs push margins down, and that is forcing Nike to lower its forward-looking guidance. With us now to take us deeper into Nike and decode what the results mean for the industry more broadly is Berna Barshay, editor and research analyst at Empire Financial Research. Berna, thanks so much for joining us.
Hi, Corey. Thanks for having me today.
I'm glad that you're here. And quick side note, I was digging through your Twitter and I love it.
Oh, thank you. Thank you.
I love your Twitter, Berna. All right, back to Nike though, everyone. The company, of course, reporting a much stronger quarter than most were anticipating. What were your key takeaways from Nike's report?
Well, I think, this is a great example of the market having sort of seen the glass is half full versus the glass is half empty, right? Because here we are sitting at the precipice of people wondering what's going to happen with the consumer. Are we going into a recession? Are people going to start buying stuff because gas is $5? And, they guided to low double-digit revenue growth. And it's important to remember this is coming off of, a very strong period for Nike, and they, the key statement to me was they said, we continue to closely monitor consumer behavior and we're not seeing signs of a pullback at this point in time. So they're going to continue to watch it. But, so far so good in terms of the demand still being there. So, I think if people were feeling better about the stock market, about retail stocks specifically, and about the consumer, this stock might have been up instead of being down 7% yesterday. But right now, it's sort of like the rose-colored glasses are off, and people are looking for things to poke holes to. And everyone's focusing on this gross margin guidance of the gross margin being down 0 to 50 basis points next year. And yes, gross margin is a key way of measuring the health of a company like this that sells discretionary consumer products. But to a certain extent, the company is a bit of a victim of its own success, right? Because this year there was so little discounting because there was so little product out there. Vietnam was closed for months. They lost something like, they said, they put a number on how many pairs. I think it was like 130 million pairs didn't get made and shipped worldwide when Vietnam was closed. So with the lack of product, we had a lack of discounting, including in their own channel, which is, their own stores, and their website is now 40% of the business. So I think some of it is inflation, ocean freight costs have soared. And, the cost of materials has soared, so that's a headwind. But a lot of it, I think, is also the normalization of, a more normal promotional cadence. A little bit more discounting can be expected to come in when we're not in a product shortage situation.
Berna, I'm glad you mentioned that that's one of the headwinds, but I want to kind of dig a little deeper into their overseas issues, to say the least. I mean, just this week, China, the government has said they're going to kind of start easing restrictions, even though they didn't quite word it that way, but they did cut down the quarantine time to 7 days from 14 days. Specifically for Nike, sales in the country slipped 19%. That was largely due, Berna, to these COVID lockdowns. I mean, when you think about Nike and how crucial China's reopening is to the economic rebound for Nike, do you consider this a major component of their ability to return to solid growth?
It's definitely a material headwind, but I think it's the kind of thing where, it's transitory, like all things COVID. It seems like we hit waves and, it hit different, it hit the U.S. and Europe a lot earlier. And China is sort of stuck with this sort of zero COVID strategy, and, eventually they couldn't contain it. But, if you had bought, I just don't think that the COVID related closures, disruptions, missed sales, any of that is a good reason to be in or out of a stock like Nike. Because like if you had bought Nike in March 2020 when everybody was panicking that we were shut down in the US, you would have bought it at $67. And, at one point you would have had almost a triple. And even with the 40% decline in Nike shares, since the fall, you would still have made, a nice return of whatever, 60, 70%. So, I think that, yes, China is a headwind. Greater China is something like 15% of sales for the company. If it's down 20%, that is a meaningful headwind. But, this too shall pass. So when thinking about the stock, it's one thing if you want to like trade it for first quarter results in 3 months, but if you're looking at this as an investor, the fact that they're missing sales in China is actually just sort of a blip in, what should be a growth trajectory. And to me, the bigger issues when you think about Nike and China and its prospects are the relations between the United States and the West more generally with China. I think for all American brands, you have to think about as tensions build, whether it's over tariffs or whether it's over the geopolitical complex and, how we deal with Russia. China sort of sits between us and Russia right now. Like all those things in a way are more important long term than COVID, because you don't want the Chinese people to feel that American brands aren't as desirable because of something going on between our governments. So, I kind of ignore that minus 20%. To me, the bigger headline is the demand is still there. They're going to take a 5% or mid-single digit price increase. Historically, they've had no trouble pushing those through. And, in the world of sort of consumer retail, there's haves and have-nots, and Nike certainly still is a have, having put up the revenue guidance that they have right now, and their confidence in being able to pass on inflation.
Right.
I mean, right now with inflation, it's all about which companies can pass it on to the consumer and which companies can't.
Berna, I really like your optimism about, looking at Nike from an investment standpoint, not just, kind of a day by day trader, and that China, this isn't the be all end all, because eventually, all of the COVID sort of restrictions globally will supply at some point. The supply chain will get back in line with global demand. So we'll have to see exactly how much longer it takes us to get there. But something that you mentioned earlier that I would love for you to perhaps explain a little bit more to our community members is why the margins are such an emphasis for this particular report, and whether the direct-to-consumer, that DTC side of the business, can actually help offset some of the pressure for Nike in the near term.
Well, yeah, there's been a long-term concerted shift of Nike to move sales from third parties, from retailers, from, everyone from like the chosen few who are still their retail partners, companies like Foot Locker, Finish Line, Dick's Sporting Goods, like these chosen few that they're sticking with. Meanwhile, they used to sell in, lots of other places, from Macy's to DSW to your mom and pop, athletic store. They've been cutting out those non-core accounts to push more merchandise through their own stores and their website. And there's a lot of reasons they want to do this. They want to stay closer to their customer. That way they get better information in terms of what customers are responding to more quickly. That helps them in the product development cycle. It also helps them establish a relationship with consumers. So they made this decision that they wanted to go more and more direct several years ago, and they've been pushing forward with that. Now, that comes with financial ramifications because there's no middleman that they have to share sort of product margins with. the direct business has a higher gross margin, but it also has a higher operating cost, right? They have to pay rent for the stores. They have to pay for distribution centers and folks who work in them to pick and pack the stuff that you order at Nike.com. So it remains to be seen if it'll be overall operating margin accretive, but certainly there has been a secular lifting of their gross margins, a sort of, sustainable trend that way, because as more sales go through that direct channel, that'll push up their gross margins.
Yeah, no, I mean, this is a fascinating story with Nike too, and especially the way, as you mentioned, they're trying to have that more direct connection with consumers. Something else we know they've been battling with secondary market companies like StockX around counterfeit products being sold on their platform. So there are, excuse me, a lot of reasons why Nike wants to have more holistic control over its product. But what can we expect from other retailers in the space like Foot Locker, which is definitely one of their main accounts, not necessarily they're pulling back from, but they're saying, hey, we're not going to be pushing as many products. Are we going to start to see like a ripple effect when it comes perhaps to how well those companies perform?
Well, I actually think what's interesting here is I think the big takeaway from the Nike quarter may be that these other stocks are a buy, because I think that while everybody's focused on the inventory increase at Nike, the inventory was up 23% versus sales that were essentially flat. To me, that's not a concern. This was catch up. I mean, they were so short on inventory. So while it's normally a red flag when your inventory increases faster than your sales, I'm willing to give them a pass here. I know it's what a lot of people are focusing on, but if you talk to people in the retail supply chain at these companies, Nike, Adidas, other athletic and footwear companies very dependent on Vietnam, they were just scrambling for products. So I think that I am not concerned about the inventory being out of whack right now. I think the demand is there. They think the demand is there. But what's interesting is, Nike, it's sort of the stock right now sort of sits in this sort of no man's land of like, it's not really a value stock at 25 PE, 26 PE, but it's also down a lot. Whereas, so it's sort of seen its growth clip by these recent events with the gross margin. But, what's really interesting to me is like the Foot Lockers and the Dick's Sporting Goods, the Academies, like the other retailers that are exposed to Nike, they are going to benefit from this price increase just like Nike will. So if in the case of Foot Locker, if your largest vendor takes prices up by 5%, that's going to be a big tailwind for your same store sales, your comps at the stores, because a big percent, over 50% of the products that you sell are going to have a 5% increase. That is a good way to have some assurance that your same store sales are probably going to be positive, or at least have a tailwind. So there's that. And usually when Nike raises prices, that gives license to other companies in this space, whether it's an Adidas or a New Balance or Puma, they may follow, because once Nike, sets the lead, other companies can raise prices, and everyone's experiencing the same thing with costs escalating for both production and freight. So that's positive for these retailers. Also, the fact that there were 130 million pairs not made last year, when they were short pairs, who got the pairs last year? Who got those Jordans? Who got those Air Force Ones? Those went to the Nike stores and the Nike website before they went to Finish Line, before they went to Dick's Sporting Goods. So the fact that inventory is sort of normalized now should be a benefit, and these retail partners should have a better assortment this year. So you put those things together, and then you consider that like Foot Locker trades at a 6 PE, Dick's trades at a 7 PE, and you don't need a lot to go right at at a 5, 6, 7 PE, you just need earnings not to be cut in half. So
Right.
I think there's so much pessimism built in to those retailers right now. And I think Nike pretty much told us last quarter that they fired as many retailers as they plan on firing. Like
Yes.
the cutoffs are probably done at this point. It's been pretty catastrophic for people, but that's the rear view window, mirror.
Well, there's only thing that's constant is change, and Nike is continuing to try and make sure it maintains its hold as being the number one player in this, broader retail athletic apparel consumer space. Really quickly, Berna, why we still have you on the line, I just have to talk about Disney really quickly. Just while we have you, because for everyone who may not be aware, quick background, Disney did extend its contract with the current CEO, Bob Chapek. That's for 3 years. What do you think this says about their confidence in his leadership?
I mean, obviously you don't sign up somebody for, to make oodles of money, tens of millions of dollars a year to run your company if you don't think he's doing a good job. I have to say I was kind of shocked. I mean, it's not easy to find, a CEO to run a company with this size and breadth, but I mean, Chapek has had one scandal after another the last year. I mean, obviously there was everything that happened in Florida with the Don't Say Gay bill and, how they initially didn't come out against it, but then the employees were up in arms. So they eventually did come out against the bill. And now the governor, Ron DeSantis, is trying to take away their special tax status in Orlando. So there was that whole thing, which was front page news, top of the news hour kind of news. But there was all these other things, like, he got in a big public beef with Scarlett Johansson over her Black Widow compensation. He moved California, longtime California employees to Florida against their will. The Imagineers, like a really important group. There were all sorts of changes to reporting lines. The middle management turnover has gone up a lot at Disney. And, for anyone who goes to the parks, they know that now you have to pay $15 a day for Genie Plus for something that used to be the Fast Passes, which were free. So they really, really pissed off a lot of longtime loyal parks customers with that move as well. And while it has led to record results in the parks, you have to wonder whether or not they're being short-term greedy instead of long-term greedy there. So his reign has been filled with like one controversy after another, so much so that even like the retail shareholders had a petition for him to get fired at one point. It was mostly people upset about the changes at the parks. But the one thing you got to give Disney is they are killing it in streaming. And while, streaming has fallen out of favor a little bit on Wall Street lately, with people are starting to sort of sharpen their pencils on how profitable this business can really be. Disney's the only legacy company that I think, gives Netflix a real run for the money in terms of potentially having more subscribers than them in a few years across the the 3 different properties of Disney, Hulu, and ESPN online, ESPN Plus. So, I think that what you're hearing from the board by sticking with Chapek is they're really doubling down on this digital strategy because he has been a PR nightmare. He's been amazing for the parks making money, but, potentially is eroding some goodwill there. But it's hard to say that he hasn't that the Disney Plus hasn't knocked the cover off the ball. And so to me, a vote for Chapek, confidence in Chapek, is a vote that Disney's future remains, in these digital streaming services. That's what the board has to be saying with this.
Yeah, perhaps it is, but I'm glad you brought up that he has been somewhat of a PR nightmare. A part of me wants to say maybe Disney should move away from CEOs that are named Bob. Maybe the third one, maybe the next CEO is not going to be named Bob, but they seem to be really into CEOs named Bob.
Yeah, although I feel like, both the employees as well as sort of the Disney adults, like they're all standing for Bob Iger still. They
No one
all
wanted
sort
him
of
to
wish that
leave.
he would come back.
Bob had had
Yeah,
enough.
yeah.
Iger, that Bob, sorry, let me not do the first names here. Iger had had enough.
Yeah, I mean, he was ready, although he seems to tweet about Disney and use like, we and our, and he talks about it like he's still there. So that's probably like a little sort of,
A little bit of FOMO that Iger
sort
has.
of, yeah, a little FOMO, and probably like I'm sure Bob Chapek feels like Iger's a little bit like hanging over him, and he's still standing in his shadow quite a bit.
Well,
Not
those are
only because
big shoes for
big
Chapek to fill,
shoes, very big shoes. Yes,
for sure. Well,
one of the
thank you.
best CEOs ever. So yeah, big
It's
shoes.
hard. It's super hard. You know what? Thank you so much, Berna, for sharing your insights, taking us deep on Nike, giving us, of course, your opinion in terms of this CEO extension for Disney. We greatly appreciate it. Everyone, once again, this is Berna Barshay. She is the editor and research analyst at Empire Financial Research. Thanks so much for joining us, Berna.
Thank you. This was fun.
All right, guys, that's going to do it for today's session right here on Public Live. But of course, we bring you more great content all the time. Enjoy the rest of your day.
If you would like to see more content like this, subscribe to our channel and download the Public app where you can listen to these sessions in live time.